Hey everybody, I hope you are having a wonderful day. Here we make investing in options and stocks simple. And let's not lose any more time, let's go straight to today's topic. Now that's a big crowd. Everyone's got the same goal, make a lot of money. When most people hear the word options, they think high risk. But options can actually help you reduce risk, protect your investments, and even earn steady income from premiums. So what are options? Let's start with the Greeks. Delta, Gamma, Theta, Vega, Rho? What the heck is that? Don't worry, we're gonna make it simple. Let's start with Delta, one of the most important words in options trading. If you've ever wondered why your option barely moves when the stock jumps or skyrockets when the stock moves a little, that's Delta at work. Delta tells you how much an option's price changes when the stock price moves by $1. Let's keep it simple. If you buy a call option with a delta of 0.5 and the stock goes up $1, your option's price goes up 50 cents. Think of the stock and the option like two magnets. If the magnets are very strong, delta 0.9, they move almost together. If they're medium strength, delta 0.5, the option moves halfway. If they're weak, delta 0.1, the pull is tiny. The option barely moves. With a delta of 0.9, the magnets are almost locked. If the stock rises $1, your option rises about 90 cents. That's a very strong pull, almost 1-to-1. With a delta of 0.2, the magnets are weak. If the stock goes up $1, your option only moves around 20 cents. It reacts slowly, like a light tug, instead of a pull. Imagine you purchase an Apple call option with a delta of 0.75. If Apple's stock price rises by $2, you can estimate your option's premium will increase by roughly $1.50. $2 times 0.75. If the stock drops by $1, your option will likely lose 0.75 in value. Delta is the instantaneous prediction tool that lets you calculate your exposure and potential profit and loss before the trade is executed. Call options always have positive delta. When the stock price goes up, your call option goes up too. They move in the same direction. Put options are the opposite. They have negative delta. When the stock goes down, your put goes up. They move in opposite directions, like a reversed magnet. The delta value is a continuous spectrum defined by how far the option's strike price is from the current stock price. Deep in the money options, delta near 1 or -1. These are the strongest magnets. If a stock is at $100 and you own a call option with a strike price of $80, that's already $20 in the money. It might have a delta of 0.9, meaning if the stock goes up $1, your option goes up about $0.9. That's a powerful connection. Buying ITM options is safer because they move almost exactly like the stock. You're paying more upfront, but you have a higher chance of profit since most of the value is already real. Selling ITM options, on the other hand, can be risky. Because the buyer already has a strong position, the seller could lose fast if the stock keeps moving in that direction. At the money options, delta around 0.5. Here, the magnet is halfway strong, right between stock-like behavior and lottery-like behavior. If the stock is $100 and your strike price is $100, the option might have a delta of 0.5. That means for every $1 move in the stock, the option's price moves about 50 cents. Buying ATM options gives you balance, not too expensive but still responsive. If the stock moves in your favor, your profits can grow quickly. Selling ATM options can be risky because these are the most sensitive to price changes. They lose or gain value rapidly, and you'll feel every move. Out of the money options, delta near 0.3 or lower. These are weak magnets, almost no pull. If the stock is $100 and your strike price is $120, your delta might be just zero point 0.1. That means a $1 move in the stock only changes your option by 10 cents. Buying OTM options is the cheapest way to trade, but it's also the most dangerous. You are basically buying a maybe. If the stock doesn't make a big move, you lose everything. Selling OTM options is safer because, most of the time, the stock doesn't reach the strike price. You collect premium up front, which you keep if the option expires worthless. It's like collecting rent while the risk seems far away. But here's the catch. If the stock crashes below your strike price, losses can add up quickly because you're obligated to buy at that strike price no matter how far it falls. Don't worry though, I'll show you strategies to manage and limit this risk in upcoming videos. Now that you know delta, it's time to meet its best friend, gamma. Gamma tells us how fast delta changes when the stock moves. Think of gamma as delta's speedometer. Imagine delta is your car's speed. Gamma is the acceleration, how quickly your option reacts as the stock moves. High gamma, delta changes fast, your option reacts quickly. Low gamma, delta barely changes, your option is steady but slower. Gamma shows the non-linear power of options. It means that when the stock moves in your favor, your delta increases and your profits start to grow faster and faster. Gamma is at its peak when an option is at the money. That's when the stock price sits right on top of the strike price. This is where the action happens. A tiny move up or down can instantly decide whether that option ends up profitable or worthless. That's why gamma here is explosive. Delta swings fast and wild. This is called the speed trap because it's where sensitivity and risk are both maxed out. Now, when an option is deep in the money or out of the money, gamma slows down. At that point, the option's fate is mostly sealed, meaning the stock would need a huge move to really change anything. If it's deep in the money, the option is already behaving almost like owning the stock itself. So even if the stock moves a little, delta stays close to 1 because it's already moving in almost perfect sync with the stock. On the other hand, if it's far out of the money, it's so unlikely to end up profitable that small stock moves barely matter. Delta stays close to 0, showing the option isn't really reacting much at all. Here's the twist. Time changes everything. As expiration gets closer, gamma spikes dramatically. That's because delta is forced to make a final decision. It has to rush toward either 1 or 0. So near expiration, even the smallest stock move can send delta flying, making your option extremely volatile and reactive. So now we know that gamma tells us how fast delta changes. We also know that when an option is deep in the money, gamma calms down, and delta barely moves. It's stable, predictable, and easy to manage. And that predictability? That's exactly where smart traders see an opportunity to create steady income. Okay, let's use that knowledge to think about risk and stability. When delta is low, the option doesn't move much when the stock moves. For example, let's say a trader sells a put on Apple with a delta of 0.15 for $1 in premium. As long as Apple stays above that strike by expiration, the option expires worthless, and they keep the $100 they collected per contract. If the stock drops below that strike, the seller might have to buy Apple shares. But since they were paid up front and the strike was chosen at a comfortable distance, the risk is manageable if planned correctly. Low delta options are less likely to get exercised, but the profit is small compared to the risk if the market moves sharply. That's the trade-off. High probability of small wins, but the occasional large loss if a position isn't managed. To handle the inherent risks in option selling, we as disciplined traders implement 2 key risk management strategies. We frequently deploy defined risk structures like credit spreads. These structures are our primary tool for generating premium while capping the maximum possible loss right from the start. Alternatively, we only sell puts on high-quality stocks that we genuinely wouldn't mind owning. Now, let's say the stock moves against us and we get assigned, meaning we have to buy 100 shares. That's not a bad thing. In fact, it's part of the plan. We only sell puts on stocks we actually like. So if we're assigned, we simply switch gears and start selling covered calls on the shares we now own. That way, we're still collecting income from the premiums, and when the stock goes back up, we can sell it for a profit. It's a win-win either way. We're always collecting something. Over time, this creates a repeating cycle. That's what traders call the wheel strategy. I'll break that down in full detail in another video, because once you understand it, it completely changes how you think about options. While most traders chase every move, hoping to catch the next big swing, we're not rushing. We're letting time do the work, turning patience into real dollar bills day by day. And the secret behind that? It's all thanks to Theta, the Greek that quietly pays us just for letting time pass. So what is Theta? In options trading, Theta represents the rate at which an option's value decreases as time passes. This is known as time decay. Every option has a limited lifespan, and as it approaches expiration, the portion of its value that comes from time, the extrinsic value, steadily declines. Even if the stock price doesn't move, the option will lose value simply because time is running out. Theta decay happens because the probability of the option finishing in the money decreases as expiration approaches. At the start, when there is plenty of time left, there are many possible price paths, meaning higher uncertainty and therefore higher option value. As days go by, those possible outcomes narrow, uncertainty drops, and so does the option's price. When we sell options, we're on the right side of time. But if we're buying options, it's the opposite. Theta becomes a quiet enemy. Even if we're right about the stock's direction, if the move doesn't happen fast enough, time decay can eat away at our profits. That's why most buyers lose money, not because they're wrong, but because they run out of time. So, we understand Theta. Now, let's jump straight to Vega, because time isn't the only force moving option prices. The market's emotions, fear, and uncertainty also play a big role, and that's exactly what Vega measures. Vega measures how much an option's price changes when volatility changes. If volatility rises, options become more expensive. If it drops, options lose value. Think of Vega as the option's sensitivity to the market's emotions, how jumpy or calm things are.
Rho measures how sensitive an option's price is to interest rate changes. For call options, Rho is positive. When interest rates rise, calls become more valuable. For put options, Rho is negative. When interest rates rise, puts lose value. Why? Higher rates reduce the present value of the strike price. For calls, that's good, cheaper to pay later. For puts, that's bad. The payoff is worth less today. Rho usually has a small effect on short-term options, but it becomes much more noticeable for long-term options, or when interest rates are high. It's the Greek that tracks how changes in macro interest rates quietly shift an option's value. You might barely notice it on weekly options, but over the long term, it can move the needle. So next time you're trading long-term options, don't forget Rho.
That's it for this video on the options Greeks. Each one plays a role in how an option behaves and how risk shows up in a trade. If this helped you understand options at a deeper level, make sure to like the video, subscribe to the channel, and hit the notification bell so you don't miss what's next.